Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I got 8 ways to go to start this off. Let me just go equities 101. How far behind is the market? I don't sense any exuberance out there, and up we go. Goldman Sachs saying everything's firing on all cylinders.
I think it depends on where you're looking for exuberance. If you're looking at institutional investors, you are absolutely correct. There's really no signs of exuberance. We can see in that Deutsche Bank consolidated equity positioning, you're just slightly above overweight. Yeah. If you look at discretionary investors, they're at neutral, which means that people who are just trend followers have been sitting more on the sidelines of this market, not going all in. The contrast is with retail investors. Retail investors are very much all in on this market, whether you're looking at Fed flow of funds, AAII, margin loan balances, all of these suggest that retail has definitely pushed all the chips to the center of the table.
Starting to get into the teeth of earnings season this week, Cam, what have you seen so far? What do you think the market maybe needs to see?
I think one of the key stats to watch, and as it progresses, we've only seen about 13% of the names report. But of those 13% of names, what we're seeing is growth is coming in at 8.2%. That's effectively equal to the 8.3% that people expected going into the quarter. That's a contrast from the last 2 quarters where you had beats that were so large that you ended the quarter with effectively double the growth rate than what you expected going in. So that's probably why we're seeing this market more shrug in the face of these beats versus dancing with joy like we saw in the past couple of quarters.
I get all my stock tips from Nathan Hager. That's why I'm in the triple leveraged all cash fund. And Nathan just mentioned Kimberly-Clark. So I looked it up, Irving, Texas. We all know the name. Last 10 years, it's gone up at 3% per year. It's basically, to be polite, a failure. Okay, fine. Institutional ownership of Kimberly-Clark and the Bloomberg, 87%. Institutional ownership of Apple, 68%.
Yeah.
That doesn't make sense, does it?
Well, I think part of that is the function of people going down the list and checking the box and owning everything in every single sector, where just because they're having to benchmark to a certain index. And consumer staples are one of those things that we think that you should think of them in more of an episodic kind of way. And what I mean by that is they provide protection to portfolios in a short period of time, meaning when things really start to get squirrely in markets, that's when you see consumer staples outperform, but then they give it all back up. So when you think about retail investors who might be wanting to shoot for growth, that's probably why you see that
Okay, but is Apple under-owned? I mean, we're going into major tech. Paul, you said Apple's like this week, right?
No, they're coming up a little bit. Yeah, they're this week, along with Meta, Microsoft, Tesla.
They're all under-owned. I mean, that's a fact, right?
So not necessarily. If you go back to November, late October, what you saw in the positioning data is that mega cap growth in tech had some of the highest positioning exposure by institutions going back over the last few years. And what they were really underweight was cyclical areas of the market. And that explains why you've seen this weakness within tech and big, huge rallies in industrials, energy, materials, because here's the kicker. A lot of these tech areas have very deep liquidity and they have very large positions, but the smaller, more cyclical areas aren't nearly as liquid. So a little bit of money coming out of tech going into these smaller areas is causing this big upside.
I asked Ed Ludlow, Huggies, Kimberly-Clark, it's a cyclical.
Oh, yeah. Well, he's all in there, that household. So, again, we're going to get a lot of the big tech names, Meta, Microsoft, Tesla, Apple this week. How important are those names to this market here?
Incredibly important, simply because there's such large weights in the index. And the question will be, does the top line growth and margin expansion of their core businesses still allow them and give them the free pass to make such large investments in AI, which are really not part of their core business yet? You can't argue that Microsoft's making a lot of money off of AI at this point. We've all used Copilot. We all know it doesn't work very well. So I think that it's the core business that we have to watch really closely, because that's effectively what's allowing them to spend so much other money in these newer areas.
We're going to hear from the Fed this week. How does that factor into kind of how you're viewing the market here? It almost seems like, the Fed's 1 or 2 cuts this year. That's kind of it. Let's focus on earnings and other big things.
Look, I think that if there's one chart that could surprise people the most, and this is not our base case, but the one chart is the 2-year Treasury yield. The 2-year Treasury yield is, of course, very sensitive to expectations about Fed policy. And it has been in a very, very clear downtrend over the course of the last 3 years as we pivoted from a Fed that was tightening to a Fed that was easing. That has added to market liquidity, that has kept financial conditions easy.
Right.
If that starts to turn, meaning the market is sniffing out potentially stickier inflation or not as many Fed cuts to come, I think that's a pretty big sea change for risk assets.
Buy, hold, sell on Mag 7. We got to go to the breaking news in Washington, but buy, hold, sell on Mag 7.
Hold.
Hold. See how she says that?
Buy into weakness. The premium that growth is trading over value has compressed materially. It was 85%. In November, now it's 60, so getting more attractive.
I saw it's going to be single-digit wind chill in Florida. Good luck with that, Cam. Cam Dawson, thank you so much with NewEdge. Greatly, greatly appreciated. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
George with us right now. George Catrambone with his head of fixed income, too short a visit this morning. He's with DWS of Germany, formerly with the Deutsche Bank as well. How do you treat a big tech debt offering? You're sitting there, you're having your Chinese takeout, and all of a sudden, Microsoft with 3% debt shows up with $30 billion. What do you actually do when there's a mega deal debt offering?
With a lot of care and due diligence, and hopefully we were in on reverse before that deal actually came.
What does that mean, in on reverse?
Well, it means that we went to the syndicate, even maybe had direct conversations with the company to express interest before it actually came to the market. We'd have a group of investors that were looking for that profile or potential maturity. And then before it comes, we're going to have a lot of conversations with our analysts that are going to do valuation work and the sell side desks to see how they're shaping up. These deals have been oversubscribed 3 to 4 times. And the concession, i.e. where they're coming versus where the secondary market is trading, is very tight. And they keep coming, Tom.
There's 3% debt at Microsoft. In your head, what would be an appropriate debt percent for one of these mega techs? Paul wants to know.
Well, they have so much free cash flow, but there are some black sheep out there, Tom, as well. Like naming names, there's a triple B that I'm thinking of right now that trades more like a double B. So low single percent seems reasonable, but the problem is how far are they going to keep coming? Because this is not the equity markets. Those concessions right now will widen out, and those interests will subside if they start coming more and more and more, like we saw, and then tapping the private markets like they did to Blue Owl.
Yeah. Well, the financial companies have been just flooding the market with debt. So Goldman Sachs sold $2.5 billion of an investment-grade bond on Monday, less than 2 weeks after the firm's $16 billion. So when they call you guys, your traders pick up the phone, you're like, okay, I'll take some more.
That was a record issuance for the IG market for $16 billion. But to be fair, financial companies do this post-earnings to help obviously fuel their balance sheet and a lot of the other activities that are going on, including M&A that you touched on earlier. So we're doing the same amount of diligence, but it's expected to come from the financials. So, it's not expected to come from their heirs.
Paul and I are bombarded with questions. Amazon, what are they going to do? They're doing AI and all this other garbage, so they need to issue debt. OMG, I'm worried. You're the grizzled pro. How do you treat AI, CapEx expense, and debt issuance of these major techs?
Like I said, very carefully, but also diversified, Tom. It is interesting that you say that because the Mag 7 is becoming much more pervasive within credit indices. It was all those financial issuers, plus UNH and AT&T before. And now, if we keep up 20% CapEx like is expected, you're going to have that new, whatever you call it, FANG, Mag 7, Mag Grade 8 within the credit indices. So I think what's interesting to your point is the credit indices now are starting to change, and you're going to have much more of a Mag 3 or 4 within the top 10.
So what does that mean if it's Paul? I've never considered this.
Well, this is Rob Schiffman's all the research we like.
But I don't listen to Schiffman. I listen to George. George, help me here. Then I mean, if Amazon is in the indice of credit, what does that mean? How does Amazon's life change?
Well, at least for the moment, you're going to have more interest in being able to issue debt, but they have such great free cash flow. I don't know if it necessarily changes. The real question is, what are they doing with the capital expenditures? Is it research and development, or is it just simply leasing data centers upon, not buying, leasing, data centers and growing their business? And it really comes down to, are we going to need, is this AI expansion what everyone says it is? Will we need as much data centers? And by the way, forget about CapEx. Who pays for all the power that's required? And it's coming from as we get into midterms to fuel all this.
This new issuance, is it mostly refinancing, or is this incremental debt? And you guys care about that.
No, we certainly do. So in some instances, it seems to be incremental. The net issuance this year versus last year is actually going to go up. So you're talking about $2 trillion in overall issuance coming this year in the IG market, a couple $100 billion in net issuance. And I think that's where you could have a moment where the market actually pushes back. If those estimates get pushed up, everyone's seeing spreads right now trade super tight, right? Multi-decade tights. Those spreads will widen if you start to exceed a couple $100 billion in net issuance. Tech keeps coming, and gross issuance is beyond $2 trillion, which could be the case.
In 2025, fixed income broadly defined had a very good year in total returns, high single digits.
Yeah.
In 2026, can I expect that type of performance, or should I just be comfortable clipping my coupon here?
Yeah, to your point, 7% in IG last year, 8% 10-year total return. Our BHYB, our single B, double B high yield fund returned 9%. Wow. So I don't know if you're going to see that again, but I think the curve right now being steep, as the previous guest was mentioning, allows you to get some carry, right? But also some roll down. And that's exactly what you should be doing as the MOVE index comes down and hopefully rates volatility subsides and you're able to come down at that curve.
Just Catrambone, this is the DWS of Germany here, buying bills, notes, and bonds for DWS. Here's the headline. Thank you for the timing, George, to be here. Bloomberg Dollar Spot Index hits weakest level since March of 2022. So an international shop like you, does that diminish your appetite for U.S. paper?
Our base rate's in euros. I don't think it necessarily diminishes the return. Last year, Dixie started out, I think, the worst year since the 70s. And a lot of this has to do with, candidly, our, rate cuts that were there versus the rest of the world. Some of it also came from that yen move that you saw on Friday, right? Low volume out there. Interesting coordinated between ourselves and Japan, some rate checking, right? Amongst some sell side desks when no one was around. And I think it drove down U.S. dollar further. It could be a second half story for the U.S. dollar, though, Tom. There's that dollar smile that if the economy and the jobs market really starts to weaken, I could imagine a bid coming back to the U.S. dollar.
What are you doing in the municipal space here? Because, boy, for those of us in high tax jurisdictions, the taxable equivalent yield looks pretty darn attractive here.
Great point. So we actually have 3 state tax exempt funds in very high tax districts. Massachusetts being one of them, New York being one of them. Tax equivalent yields are super high, like 9% or so in this state right here. And talk about a curve that's steep. That curve was super steep and had a ratio of near 100% where treasuries are. It's back down around the 60 to 7% area right now. But again, pushing out that curve to get some of that roll down is exactly what we did last year. And I think that's really smart to lock in some of those yields. It's a market that hasn't really grown, that's issued a heck of a lot last year and will continue to issue this year.
That's what I heard, because we do a lot of stuff, a lot of work with BAM, Build American Mutual. 2024, record issuance. 2025, record issuance. And they say again this year, record issuance. Is that makes it difficult for performance for these bonds?
I think not necessarily if you barbell out it the right way and you have good security selection, which is exactly what we're doing.
Okay. I got it. You're president of your class at Providence. We're asking all of our guests, particularly fools that come into the studio, given the weather. I mean, when you're president of your class, do you avoid Sullivan, Davis, and Bedford at Providence College so you don't have to walk that hellacious walk? Folks, Providence College is a little bit warmer than like Bucknell or Lawrenceville or, some of these other schools, Rochester Institute of Technologies. But you guys major in wind. You walk into class in 5-degree weather there. The wind chill's like 30 below. I
was right down lower campus, Fennell Hall. Good morning, Providence College. I had to walk up to campus right near the tennis courts every single day, Tom. Both ways uphill. I didn't promise any 10% credit card caps when I was running for president.
Was this with the Narragansett Lager beer in your hand?
Yes, there was absolutely against it in left and right hands. On the right.
Very good. Great to see you. Thank you for your support to your college, Providence College. Congratulations on that. Mr. Catrambone, George Catrambone, head of fixed income, DWS Group. That was brilliant, folks. I learned a lot there, particularly on high tech and what they're going to do with presumed bond issuance. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is our interview of the day with Global Wall Street. Kit Juckes with a blistering note over the weekend for SocGen. He follows up. Again, Paul, I got a problem. He's like using Ash's cricket talk.
Oh.
In his research, I have no idea what he's talking about. Let's get some clarity right now. Kit, I want you to inform our audience of the power of the politicians in Japan, the power of their central bank, the Bank of Japan, the power of MOF, the Ministry of Finance. What is their power with threat of intervention to change U.S. markets?
Short term, they have a lot of power because if they come in, intervene, and move their currency, strengthen it, they can weaken the dollar. They can get the U.S. Equity market doing better. If they intervene enough in their bond market and stabilize long-dated JGB yields, they can probably push down 30-year Treasury yields and play a big part. So they are not powerless. They're the biggest foreign holders of your debt as well. The challenge they have is their economic problem, that they have a debt level that's way too high. And if they try to solve that by coming in with really tight fiscal policies, cutting spending, raising taxes, and give themselves even less growth, they'll never escape it. They have to get out of that debt trap.
This is really important, folks. I'm not going to make this a history lesson from Mundell to Frankel to Dornbusch to Rogoff and on to Kit Juckes. But Kit, interventions are rare. What's the x-axis if and when Japan intervenes? How long does that effect last? Is it days? Is it weeks? Can it be a seismic shift to years?
On its own, it's days. If you catch a market that's got the wrong position, you can scare speculators, discourage people from putting trades on, have a bit of behavioral impact. But if you don't do anything to back up your intervention with policy change to get your currency going in the direction you want, it won't last. If you do it at the time where the market doesn't understand the policies you're making and they're the right policies, and then the market realizes, everyone goes, oh, that's what they're doing. They're actually doing things to get faster growth. They're liberalizing their economy, deregulating. They're going to get this thing to really happen. Then it can work for years. So the last few interventions in Japan have had a very short shelf life because nothing changed beyond the intervention.
Kit, last week was a very busy week for global geopolitics with the world's leaders, many of them gathered in Davos, Switzerland. Did anything come out of there, just the level of uncertainty perhaps impact your outlook for just currencies going forward for the remainder of this year?
I think the level of uncertainty was the message, the kind of, it was quite combative. It's been less combative since President Trump's come back. But my sense from it is, I have a world in the foreign exchange market where the dollar is, Bloomberg has seen its consensus GDP growth forecast, so from people who participate in that, rise to its highest level yet in this cycle, up to 2.4% growth, at the same time as the rest of us are dawdling somewhere below that. The only people who are close are Australia, and US has gone above them. It's very unusual to have people revising the US economy forecasts higher and higher, and the market's selling the dollar like this. But they're doing it in the sense that despite this strong growth, we're not going to see tighter fiscal policy. We're not going to switch the fiscal monetary policy mix to get a weaker currency. The US is just going to cut rates because it's going to cut rates. And that's not a very stable kind of place for the market to be. And that's the uncertainty that came out. And weirdly, in the past, uncertainty might have helped the dollar. Now, clearly, it isn't.
Interesting. Kids, we had President Trump came into office this second term stating that he and his administration wanted a weaker dollar. Looks like they're getting their wish here. How do you think about the dollar here going forward?
I think that if you've got the strongest economy in the world, you'll end up having the strongest currency somewhere along the way. So I'm with your very wise previous guest. Actually, I think that was it. I think we can have a weak dollar through the first half of this year. We have forecasts of 120 Q1, Q2 for euro dollar. I kind of thought that was mad on January the 1st and didn't change them because I'm too lazy. I'm quite keen on that now. I think we can stay at these sort of higher levels than this for a while.
Right.
I think the dollar is going to be stronger by Christmas unless the U.S. economy slows down a lot, and that'll only happen if there's something goes wrong in the equity market. Can't see that yet.
Well, there's a money statement for you right there, folks, on dollar strength end of the year. Kit, let me finish with this. I'm standing in the news bureau of Bloomberg News in Tokyo, and I'm on the phone with Matthew Winkler, who, is the one that brought me to Bloomberg. And, he's editor-in-chief, and he's like, Tom, explain to me sterilized intervention. So, I was a C student, I butchered it. But my basic idea here is none of this works without this fancy phrase back to Krugman and Opsfeld called sterilize. And if you intervene, you have to go over to your bond market and make adjustments. Japan doesn't have those degrees of freedom, do they? They can't sterilize, can they?
No, but if so, what we need to do is to create a situation where Japanese investors who today hold, huge quantities of U.S. treasuries because the yields are so much nicer than in Japan, they don't want to support the yen with higher and higher bond yields in Japan. That's not going to do it because it'll kill their economy. So they have to find a reason to get investors in the near term to believe in the long-term story and to sell, for example, their U.S. treasuries to buy Japanese equities, or their U.S. treasuries to buy some Japanese short, not really super long-dated bonds necessarily, but to believe in the policy changes they're making and get money to move. It's a tall order. They've got a new government that's going to try to do it, but that's what it'll take.
That is a human condition, to believe, to hope, maybe. Kit Juckes, what a clinic. Thank you so much. He is with Societe Generale. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Lisa Mateo out today. Alexis Christoforous rocking the batteries and the socks.
Yep.
I mean, that's how she got here. What do you got in the newspapers
Got the hand
today?
warmers, too. So I'm going to start with a Bloomberg Big Take. This is about college endowments. So Yale used to be sort of the gold standard here, right? They would bet on private equity, venture capital, hedge funds, these sort of illiquid investments for the long haul. But guess what? Old-fashioned stocks and bonds doing better, outperforming. And there's an example of this. University of California's school system shifted just a small piece of their endowment away from sort of the costly, complicated hedge funds and venture capital and into stocks and bonds. It returned 15% average annual return over the past 3 years.
But here's the big thing. When I first started working on university boards, and I was shocked, Tom, at the allocation to alternatives. I thought, 40%.
I'm not invited.
And I'm like, this is not going to turn out well. But for decades, it did work well.
You're 100%
but now
correct.
It's not.
100%. I'll editorialize, folks. I'm on stage at Darden at Virginia. We're rocking the room. It's all endowment people in that. And the head of endowment, who was like number 1 or number 5, whatever, in the country at UVA, says our alternative percentage is like 2%. And that was their 100%. He said on stage, 100% of our outperformance is we were in simple stuff. That was brilliant. You can't top that. Don't play with your batteries and your socks.
It's cold in this room. All right, next up, but we're going to go to Finland. This is a Business Insider story. So Finland poaching top tech talent from the U.S. We knew it was going to happen. So we already know Finland is a big tech scene. Now it's positioning itself as a place where American tech workers can find better work-life balance without sacrificing their careers. Get this, there's a law on the books in Finland that says you cannot work more than 40 hours a week.
Really?
Tell that to the finance and media industries in our world. So once you get a job offer there in Finland, you can get yourself fast-tracked to have a work residence permit in as little as 10 days. And guess what? So can your spouse.
Oh.
I've been there for Putin, Trump, gorgeous summer day, great. Paul, this morning, Helsinki. The sun comes up 15 minutes before 9. The sun sets at 4:15 sharp. 7 hours, 34 minutes of daylight for your tech job in Helsinki.
You got to deal with a little darkness, but maybe your quality of life's better.
All right.
And then the New York Times. I personally love this story. A 6-figure income working from home, making sourdough bread.
There you go.
I didn't read. Thank you. I saw it. I didn't read it. Continue.
Yeah, no, it's worth a read. So I think this is secretly my dream. People, social media has a lot to do with this because you see these women taking out their fermented sourdough and they're kneading it and making these beautiful breads and, posting it on social media. Well, some of them are leaving their day jobs. There was one woman in this article who they featured, left her career in finance to start her business. She found work-life balance. She makes 400 loaves a week. She distributes it to 11 locations in North Carolina. She does have to get up, though, at 3 a.m. to make the bread.
Okay.
But, I'm already getting up at 3 a.m.
Exactly.
But she delivers to 11 bakeries or whatever.
Yeah, and she's doing really well. And she even has 5 employees, and she's working from home. So, look,
it's the gig economy, I guess.
Nick Booth at Stanford is huge on this. He's really pushing against a lot of corporate America, including Dr. Booth is pushing against me. He just says, I'm sorry, it works.
Yeah, the gig economy. You go into any Starbucks and everybody's got the laptop open. And I think that's like a big part of GDP. Yeah. People doing their gigs from there.
It's getting easier. Like I don't get on the iPad, and recently, just last couple of days, the iPad is pretty spectacular.
Yeah. Yeah,
it's not mine.
People
Tom, are you just realizing this? It is.
Yeah,
it is good.
Afterthought. I don't have any of these toys. Afterthought has it. So,
gotcha. So make some sourdough is the takeaway from that article.
Do the batteries last one day, or do they rechargeable?
I don't know yet. I just put them in.
Okay, thank you, Alexis Christoforous. Thank you so much, Toasty Warm here with the newspapers today. It's the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.